Finding a good rental property can be tough. There's location, price, taxes, and a whole lot more. However, the biggest questions beginners have is this a good deal? Today I'll be sharing different ways to look at these properties to determine their profitability and help you make informed decisions before you invest. By the end of this video, you will have all the tools you need to properly and confidently analyze any deal that you come across to see if in fact it is a good deal. Let's go. So in a previous video, which I'll be linking on screen, I talked about the key metrics you need to look at when determining if a rental property is a good deal, which is taxes, location, financing options, rental market, and a whole lot more. So if you haven't watched that one, then I suggest you do that before watching this one, because today's video is going to be talking about the actual metrics in determining the profitability of a rental property. Okay, so the big three methods to determine profitability are cash flow, cap rate, and cash on cash return. Now, cash flow is the amount of money left over after all the expenses have been paid. You take the gross monthly rental income and then deduct all the monthly expenses like the mortgage, taxes, insurance, maintenance, CapEx funds, potential HOA fees, potential property manager fees, and more. And whatever left is the cash flow. Now, some people don't account for the CapEx fund, which is saving money for eventual big expenses like the roof, boiler, or furnace, or they don't account for potential property manager fees, which usually will run you 10% of the gross monthly rent. But I think these are necessary because you will eventually need to fix something and you will eventually need to grow your portfolio, which you will eventually need a property manager. So if you account for these factors early on, you can still turn a profit and you'll be golden. Next is the capitalization rate, or the cap rate, which measures the property's rate of return. Now, the formula you use is as followed. Cap rate equals net operating income divided by purchase price times 100. Now, the net operating income, or NOI, equals gross rental income minus operating expenses excluding mortgage payments. Now, the cap rate can vary, and it might not be the only thing you're focusing on. A cap rate of 6 to 8% is pretty good, and what people want to strive for. A lower cap rate might mean a more competitive market, but it also could mean long-term appreciation. A higher cap rate might mean more riskier area, but potential higher earnings. Lastly is cash on cash return, which is the actual return of the cash that you used in the initial investment. Now, cash on cash return equals annual cash flow divided by total cash invested times 100. Total cash invested includes down payment, closing costs, and initial repairs or renovations. You are trying to aim for a return of 8% or higher, but this can vary based on the market. Remember that stock markets typically have a return of 7%, so anything less, and it might make more sense for you just to invest in the market. Now, two other things you need to take into consideration is appreciation and depreciation. Appreciation is the natural increase in the value of your property over time. This can be caused by market demand and/or improvements done to the property. You are basically getting free equity over time, and you really only get to use your appreciated value if you sell the property or refinance the loan. Now, depreciation is the natural decrease in the value of your property over time. And yes, they both happen at the same time. This can be caused by wear and tear, the aging of the property, and market conditions. Depreciation works in your favor because you can use it for a tax deduction, reducing your taxable income even if your property is appreciating in value. Now, these two factors greatly help people in determining if a property is worth pursuing. Many people will use appreciation to refinance their loan and actually take more money out to buy other properties. On the flip side, people use depreciation to actually lower their taxable income and keep more money in their pocket. Everybody wants a good deal, but what a good deal is depends on who you ask. So what the real goal should be is learning how to assess the potential of a property based off of your goals, the market, and the finances. By understanding what to look for, you will have the confidence and the know-how to look at any rental property to see if it goes along with your investment strategy. And with that, I'm Evan, and thanks for watching. If you liked what you just saw, then click on the video here. Also, if you haven't, like, subscribe, and hit the bell icon so you don't miss any future videos.